Hi, folks. In today's video, we talk about the price melt-up currently raging in stocks, bonds, gold, silver, Bitcoin, practically everything except the US dollar, which has been falling hard. Will this continue? Is it time to learn to love the melt-up and jump on in if you've been on the sidelines? Or is the risk of a painful market correction that much bigger at this point? Listen in as we discuss these topics and more with today's guest expert, longtime fund manager Doug Noland. We were extremely lucky to land him for today's interview. Oh, and if you've been enjoying these weekly market update videos, be sure to subscribe to this YouTube video channel. The more subscribers we get, the more really big expert guests we're able to get on the show for you. All right, let's get started. Hello. I'm Adam Taggart, co-founder of peakprosperity.com, and welcoming you back for another week of looking at these markets and trying to make sense of where things are headed. This week, we're very lucky to be joined by expert guest Doug Noland, who's the well-known and well-regarded portfolio manager of McIlvaney Capital Management. Doug, thanks so much for joining us this week. We really appreciate you taking time out of your busy schedule here to talk to us.
Hey, thanks for having me. Thank you.
You're very welcome. So, Doug, I'm really excited to talk to you, given your professional expertise. I know that you've been managing capital in these markets for several decades now and have seen pretty much everything the markets can throw at you. And we've been talking in past weeks on these videos that we may be seeing some things this time that portfolio managers haven't seen in a long time or perhaps ever. So really looking forward to getting your seasoned expertise on this. But before we do, as we do every week, we're joined by the lead partners at New Harbor Financial, the financial advisor officially endorsed by peakprosperity.com. So we're joined by John Lodra. Hey, John, how are you?
Hi, Adam. How you doing? Hello, Doug.
Hi, John.
Doing great. And Mike, hey, thanks for joining us too, buddy.
Hello, everyone.
All right. So guys at New Harbor, I want to very quickly before we talk with Doug here, just want to see if you guys have anything to react to in terms of what's happened in the past week since we've last talked. I'm going to throw just a couple of slides up here really fast. The economy situation is still pretty ugly. I've got a slide up here of the GDP. In Q2, I guess the good news is we initially were seeing Atlanta Fed estimates north of negative 50%. Looks like the GDP for Q2 officially came in around negative 32%. But as you can see in this chart, just horrific given what normal GDP growth is. And I think that's the largest down quarter ever in the history of US GDP. Bringing up this next chart, things are still pretty awful on the job fronts. We've been tracking the over 50 million Americans that have had to file for initial jobless claims. This is a chart of job cuts by company. And you'll see here that things have just spiked ridiculously in the past couple of months as we've been going through the recession here that the coronavirus has brought in. Now I want to switch from talking about the damage to the economy to the really surprising strength that we've been seeing on the financial market side of things. It has been a V-shaped recovery in the markets, even though it has not been in the economy. And I wanted to walk through just a couple of quick indicators. So first one here is the Buffett indicator, which we've talked about in videos past. This essentially is sort of a PE ratio of the entire market. And what we're seeing, as we predicted, is record highs on this indicator. And this has been made famous by the billionaire investor Warren Buffett, who says this is his general shorthand indicator for whether things are overvalued or undervalued. So you can certainly see that when you're at an all-time high in this indicator, we should be hopefully, or if we're prudent, we should be concerned about today's current valuations. Next slide here is a chart of Apple, and you can see that Apple is in full melt-up mode. And you can see here in the last couple of months here on this chart, it's well above the upper range of its Bollinger Bands, certainly more so than it's ever been in the past decade. That's indicative of virtually every financial asset these days. So here's a chart of the Tech 100. You'll see a similar parabolic rise here, a similar melt-up. We're seeing it in the S&P. This is a chart of the S&P over the past couple of months. You can see, again, that's running up very close to all-time highs. Gold is now officially at record territory. We've been following that over the past month or so on these videos, but in the past week, gold has continued to punch above its all-time record highs, and as we speak today is sitting at another record high. Same thing with silver, not at record highs, but certainly at a decadal high, or since 2011. So we're seeing a similar run up there. Silver was around $12 an ounce just as recently as mid-March. Now it's, I think it's over 28 as of today. We're also seeing similar price melt-ups in the cryptocurrencies. Here's a chart of Bitcoin, which again, back in March was down in the 5,000 range or so, now flirting with 12,000. In fact, the only place we're not seeing a melt up is in the US dollar. We can see from this chart here that the dollar has actually been taking a big prolonged hit, starting from, again, the V recovery in late March. From its April highs, it's down pretty substantially. And of course, as the dollar falls, that typically tends to have an inverse relationship with things like stocks and gold and whatnot. So it's certainly probably got some explanatory power there. But again, it's sort of a reverse melt up from what we're seeing in all sorts of other financial assets. And of course, as financial assets goes up, who benefits the most? Well, it's the people who own those financial assets. We've talked a lot about how over 50% of stock market wealth is owned by the top 10% of households. It gets even more extreme at the concentrated ends. The billionaires, I'm putting up a slide here, some of the most richest billionaires in America, Bezos, Gates, Zuckerberg, Buffett, and Ellison, have seen their wealth grow from by a combined 20%. And that's just between March and June 17th. That actually doesn't even reflect the big melt-ups that I've just shown in those charts. So, I mean, that's a gain of somewhere like around 600 plus billion, over $500 billion going into the pockets of those 5 men. It's really showing the extreme inequity in terms of what's going on with the central bank's response to the downshift in the economy. They've been flooding the system with money, but that money, as we've been talking about a lot, disproportionately rewards the already wealthy, and the vast majority of other people, basically get peanuts in terms of these stimulus checks, and they get to lose their jobs in the bargain. So long story short, guys, we are seeing melt-ups everywhere. We are seeing big tech basically run away with all the riches from the game here, all the marbles from the game. Big question for you guys: in the midst of all this melt-up across almost every asset class that we can think of, how are you looking at this? Are you seeing this as a blow-off top? Are you seeing this as maybe entering the new phase of a new bull market that is backed by central bank largesse? After the run-up of this big week, what's on your guys' radars?
I'll take a first shot at that, Adam. To ponder or even ask the question, are we on the brink of a new bull market? I think perhaps is jaw-dropping in its own right. To think of embarking on a brand new bull market at literally the highest valuations of all time, it just is kind of the definition, I believe, of kind of suspension of disbelief. No, we don't think it's a new bull market. We think, rocket ships and spikes higher are exactly the kind of things you see in bubbles. And we are in a very persistent, thick-skinned bubble that is being aided and helped with by, just absolutely fire hose policies of liquidity and juicing the markets. I think it's really nothing more than that. And I don't mean to belittle how powerful these forces are, but I think it's just, kind of the data certainly doesn't speak to any kind of healthy market. It speaks to a absolutely viciously overvalued market that is just, kind of tripping on itself to justify itself for going even higher. I think that's in a word what I would describe this market to be.
All right, thanks, John. So, Doug, let's come to you now. So, you have been managing capital. You're currently managing capital in this market, but you've been managing capital for decades now, both at McIlvaney and then before you were at the Prudent Bear funds. Um, as you look at what's going on right now, and knowing that it's happened on top of a prolonged bull run over the past 10 years. There's a lot of people right now that are saying, a little bit contrary to what John was just saying, hey guys, you don't understand, it's different this time, right? The central banks proved after the great financial crisis that they have got the markets back. And since the coronavirus hit and kicked the global economy in the gut, they have proven that they're going to step in, and if it takes multiple trillions within just a couple of months, they're going to do that. If it's going to need more, they'll give more. We're seeing not just monetary stimulus with the central banks, but we're now seeing fiscal stimulus with national legislatures. They're willing to step in and spend. Is it indeed different this time? Or let me put it this way, how are you looking at the situation as you're having to allocate capital in this market environment?
Sure, Adam. My activities in the market go back to 1990. I worked for basically a short biased hedge fund back for much of the 1990s. Tough environment to be on the short side. So I witnessed the 1990s bull market. Actually, at the end of the 90s, in 1999, I started my blog before they were called blogs, and I called it the Credit Bubble Bulletin. And I expected bubble to be in the title maybe for a year or two, right? This was back in 1999 when things were really crazy. Well, here we are, 2020. I'm still writing my blog every Friday, and my analysis, to me, it seems rather clear. This is a historic, a multi-decade bubble. And as I always say, things get crazy at the end of the cycle, right? We know that from reading history. If this is in fact a multi-decade cycle, a historic bubble, then I guess we should not be surprised if things get really crazy at the end. And that's what we're seeing right now. And I, as an analyst of bubbles, I never try to predict, when they're going to implode. Or I shouldn't say I never did, but I do it at my own peril. But I've said over the years that bubbles go to unimaginable extremes and then double, right? So that's kind of the stage we're in. I think just a speculative melt up, not the start of another bull market. It's the end of kind of the very late stage of a multi-decade boom and bubble.
All right. Well, thanks for being so clear about your position. It's because you've been managing money for as long as you have, and are, let's say, very bubble aware, meaning that you're quite learned on historical bubbles that have happened both during and before your tenure in terms of being a money manager. How would you rate the current environment we're in versus previous bubbles?
Right, and there's nothing to compare this to. 1999, there was some extremes there, right, with the technology stocks, et cetera. We saw the big divergence between fundamentals and stocks in late 2007. There's some similar. We saw in the first quarter of 2000, we saw a melt up, and I think it was a big short squeeze and derivative related, where we saw the big tech stocks just do a final melt up in the face of deteriorating industry fundamentals in the first quarter of 2000. There's a lot of similarities to that to today, but what we're seeing today is, right, this is a melt up in equities. This is a melt up in sovereign safe haven bonds and corporate debt. And the way I look at it, there's a lot of focus on the stock market bubble. To me, this is a global bubble in financial assets. And things have just gone completely wacko. And why have they gone wacko? Because the central banks now create trillions of new money out of thin air and throw it into the markets, and things have just gone haywire.
All right, so let's try to make this real for the people who are watching. And just as a clarification, we have people sort of all over the spectrum in terms of investing knowledge here. We've got some people that have been following the markets incredibly closely for decades. We have some people that are very new to the process of investing. In this type of market, what would your general advice be to people in terms of what they should be expecting to happen from here, or at least what they should consider doing? So I don't want to put words in your mouth, but things like, from what you've just said, I would assume that you would say probably better to be defensive than offensive here. And that's if you assume that this bubble ends like many past asset bubbles did, in a really painful bursting. But I don't know, is that the risk here, or do you think it could unfold differently?
Well, all we have to do is look back to March, Adam, and to see how quickly things unwound. I think it was 9 trading sessions from all-time highs to an emergency Federal Reserve meeting. Not many weeks from all-time highs to the Fed injecting trillions of dollars to basically, reverse what was an unfolding global financial collapse almost. We saw dislocations across the board in the market. So, I think that was a wake-up call. Unfortunately, I think most now will see that as something that the Fed resolved, and they'll resolve the next issue. But I'm just very, from my framework, from my analytical framework, this continues to be the worst case scenario unfold. With, we're almost a year into QE, right? QE started back in September, and it started with markets at basically all-time highs and unemployment at 50-year lows. And now it's continued. The Fed's balance sheet has grown by trillions, and I think it's just the hook that gets everyone in the market. It kind of emboldens those who say the Fed has everything under control. We don't have to worry about risk, because eventually stocks, even if they go down temporarily, they always quickly rebound. So this is a very dangerous environment. I strongly recommend, unless it's money that you're willing to put at high risk, to be defensive, to be cautious. And I would argue it's time to do your best to pay down debt, get your financial house in order, in preparation for what I fear is going to be a very difficult and a long downturn. And we're used to these short downturns that the Fed comes in and rectifies. I think this one could go on for quite some time.
Okay, and not asking for a prediction here, but when you say a long downturn, are you talking months? Are you talking potentially years? Like, what do you think is possible?
Yeah,
not probable, but possible.
Right, and it wouldn't surprise me if when the market reverses lower and we go into a really difficult bear market, that let's say NASDAQ doesn't see these highs again for, it could be 20 years. The S&P might not see these highs again 10 years, 20 years. When will Japan's Nikkei reach its highs from 1989? Will it ever do it? I guess it will eventually, but it's probably still decades away. So those are that's the scenario that I'm concerned about. This view that markets always go up, that's not supported by history necessarily.
All right, and so I we didn't invite you on for this reason, but it's wonderful to hear how your outlook really gels with generally the one that the folks from New Harbor and I discuss on a weekly basis. We share a lot of the way you look at the world here. It's great to have that validation. I'm going to ask this question, which I asked maybe slightly earlier, but I'll give you one more chance to clarify anything on it if you want, which is, there are a lot of people out there. Let me put it this way. You worked for the Prudent Bear Fund, right? As John said earlier, it's getting harder and harder to find bears out there. A lot of the very, sort of visible and well-known famous bears, if you will, market bears, a number of them have capitulated over the years, and a number have really begun capitulating in the past month, given where things have gone. So there is a sense of whether it's despair or whether it's realizing that an infinite printing press can literally print an infinite amount of money should it actually decide to, where these people are thinking that, what, the Fed and the central banks may really never let the markets go down again. what kind of constraints are there, or what's the other side of that argument to say, look, there are problems out there that just more money can't necessarily fix?
Sure, and great question, Adam. The way I view it is, the Fed is aggressively adding liquidity in the throes of a powerful bubble. So the liquidity goes into the system. What does it do? It goes into Apple, Amazon, Tesla, right? It goes into those stocks. It's not going to go into the real economy. And what it does, it just makes this divergence between economic prospects and inflating asset prices even greater. And also, I think the key here that's not appreciated, because there's not a lot of transparency, what the Fed does, it basically encourages more leveraged speculation and speculation generally. So it just makes the bubble bigger. I argued in recent years that the Fed's balance sheet would go to $10 trillion during the next crisis. Why? Because I view the amount of global leveraged speculation as unprecedented. And when you get into a situation like March, where you have a de-risking, deleveraging dynamic, the only buyers are the central banks. So the only place for these positions to go are central bank balance sheets. Well, the Fed increased its balance sheet by $3 trillion, but I think they only made the speculative bubble bigger. So the next major de-risking, deleveraging, the dislocation, well, the Fed may have to increase its balance sheet by $5 trillion. Okay, if that makes the stock market go up, I guess that's something. But what does it do to the real economy? And that's what we're seeing today. I mean, I've argued for years that Federal Reserve policy was creating this inequity, inequality throughout the system, right? Inflate stock prices, financial asset prices, while the real economy doesn't do well. Well, we've seen over recent months how this really works, right? We've seen it. And now I think people are more focused on this. And I think the Fed is really trapped in this dynamic where they're just stuck inflating financial asset prices, risking their credibility, risking the what I call it the moneyness of central bank credit, the trust in central bank liabilities, the trust in government debt, because all this central bank money printing is basically giving a blank check to Washington and governments around the world. So that's part of this scenario that I'm talking about, this finale in financial assets. And what we're seeing now, the real danger here is we have a massive increase in non-productive credit at inflating prices, right? We create all this new credit and the central banks make the price go up. Well, that's unsustainable, right? There's not real value behind a lot of this credit. And eventually, real value will mean something as far as what people want to hold, how they value things. So that's part of my, the really negative scenario that I see unfolding. I hope that it's not as dire as I fear it is.
Me too. Although it doesn't inspire confidence that your prediction that the Fed may have to print, get its balance sheet up to 10 trillion by the next crisis. And we had this issue earlier this year, and we're already above 7 trillion, right? We're already getting pretty close to hitting your goal.
Didn't take long.
Yeah, John, I'm going to come your way because I saw you nodding earlier a fair amount to a lot of what Doug was saying, and so I want to give you a chance to the extent that you've got anything that you wanted to add on to or to what Doug said, or maybe ask him a question. But it seemed like a part of his answers there were really resonating with you. And then after we do that, Doug, I do want to come real back quickly to this point of inequity. It's something that I and John and Mike have talked a fair amount about in the past. And, I think the question I'll have for you there is, if violating the trust in money is one of the potential constraints of the Fed, if we continue on the current status quo, when do you think we could hit that boiling point where that trust is broken and the populace just sort of rises up and says no more? But with that said, John, was I correct? Was there something that Doug was saying that you wanted to tack onto there?
Yeah, I mean, I think pretty much all he said, we very much agree with. We think this is not a episodic bubble as much as it is a systematic bubble that's been, kind of engineered over decades through monetary policy and debt, credit growth. So this is, I think, the late stages or culminating stages of that kind of bubble. And in many ways, the bubble we're in right now is a continuation of the tech and the housing bubble, because each one of those were compounded by Federal Reserve interest rates being lowered to kind of inflate asset prices on this mentality that, hey, people are going to feel wealthier and spend more. But all it did each time is create more debt and more speculative powder keg in the system. And this is what we've got now. You asked Doug, what point does this really help solve things? And, no, at some point, more and cheaper money doesn't solve anything except invite more speculative behavior and more enabling of companies and endeavors that have no productive or societal value, the so-called zombification. That's the central feature of capitalism, to make sure that, bad actors or non-value producing companies are flushed out of the system. And all this does is enables those otherwise marginal or suboptimal activities, and fuel the speculators. So no, it's actually to the point of damaging, not helping. It may give the appearance of, hey, what can go wrong? The stock market's going up and up, but make no mistake about it. There are further and further impairments going on in the economic system as a result of these policies.
All right, well said, John. And Doug, as I said, I'm coming back to you to talk to you about the inequity part. As I do, I just want to bring up this image. I'm going to read it for the folks that might be listening in and can't actually see the video. But this is an ad that I found saw online earlier today on zerohedge.com for folks that go read Zero Hedge. The ad says, "Trade options in retirement. Wendy Kirkland's investing course shows how to earn extra income trading options." And it's got a picture there of a nice senior couple. When we're at a point in the story here where we are promoting trading options to seniors as a way to actually get some extra income, I think that does an awful lot for showing us sort of where we are in the absurdity of this situation. And the sad part is I think there are seniors that are probably going to be tempted by that, because in this, zero interest rate environment, the contract with America's seniors, or seniors around the world really, has been broken, right? You can't live off of your savings, right? You can't live on a fixed income anymore, because fixed income doesn't yield anything in a zero interest rate environment. But basically, to dangle options out there to people who need to be, preserving their capital to be able to make it to the end of their lives. It's, all the adjectives that pop into my mind are they're all super negative, right? I mean, it's negligent, it's criminal, it's immoral, and it's clearly going to end badly. So as we talk about kind of breaking the covenant of really what a central bank should be doing, with money and the populace, if we continue the status quo, how soon do you think that trust could be lost? Is this something they could get away with for many more years, or is it something that you think has a shorter lifespan?
My view is that we're at the end game of this multi-decade bubble. And I would look to the central bank balance sheets. I mean, why are they growing by trillions now, right? We did 1 trillion of QE back in 2008. We did 3 trillion in a number of, not that many weeks back in March. So I fear that we've only made the bubble larger. I think the bubble is global. And I fear that the next dislocation in global markets, you could have central banks and, the Fed's balance sheet grows another 3 trillion, another 5 trillion to try to stabilize the markets. And what happens if they don't stabilize the markets? And we saw hints of this in March early on in the process, because the initial moves by the Fed were not well received in the markets. And there was this view unfolding that, the Fed doesn't have this under control. The Fed then came with overwhelming force, grew their balance sheet by several trillion, reversed the markets, a speculative run took over. But I think the next downturn, the next dislocation, that could be the point where the markets question whether the Fed really has this under control. And they could look at a $10 trillion balance sheet and say, wait, where does this end? What does this mean to the dollar? What does this mean to treasury yields? And there could be a major reevaluation. So I don't think this last years from here at all.
All right. Okay. So we're approaching a real end game that could have incredibly large and for many people probably painful results if it results in this type of repricing that you're talking about. All right. So what we try to do with these weekly videos that we're doing is really try to make what's happening in the markets intuitive and relevant for people. And first off, thank you. I think you've done a great job of helping people understand, a relatively esoteric concept for sort of the average American, right? Not everybody in America, in fact, most people don't really know what a central bank is or what it does. And many people think of the central bank as the hero in the story because they're stepping in to help us in this time of need. And they're not really cognizant of the central bank's role in making such an unstable, unsustainable system in the first place. So anyways, I think you've done a really good job of letting people know that, hey, we're in totally, terra incognita in a way where we're seeing lots of things that are more distorted than we've ever seen them in the past. And therefore, the odds of some sort of really painful repricing are quite high, much higher than you've seen in your entire investing life. You've said this bubble sort of dwarfs all the ones that you've seen before, and it's in almost every asset class, if not pretty much every asset class at this point in time. So we get asked every week by people, and I get the question. I understand the thought behind it, but they say, hey, every week you guys seem to give us some context that says that the markets are unstable and that this house of cards is going to come down at some point in time. But it just keeps going higher week after week after week. And I know you're a student of bubbles. Bubbles are psychological events. They become a mania at the end. And to your point, they can go to extremes you could never have imagined and then double from there, right? That's what you said earlier. So my guess is your advice to those people would be, don't get caught up in the mania. Don't interpret that doubling as sustainable, organic, authentic growth in value. See it for what it is, which is a psychological event, not unlike the Dutch tulip bubbles of hundreds of years ago, where everybody all of a sudden decided that these plant roots, were worth a ton of money. And then of course that collapsed overnight when people realized what they truly were. And so, my sense is you would tell people, look at it as a psychological event, not an underlying fundamentals-based economic one, and prepare accordingly, which would, I think we could all interpret as don't do things that are going to put you at undue risk if that correction that you're thinking could happen actually happens. Did I summarize it right, or would you put some additional color around that?
Yeah, that's absolutely right. And this is really a difficult period for people because when we think of tulip mania and some of these other bubbles in the past, we think of these crazy people running around doing crazy things. Well, I look at it a little differently. Today, it appears perfectly rational to buy stocks, right? It doesn't seem like it's anything crazy. They do always go up, and the central bank's there as a backstop. It's very difficult not to get involved, right? It's Kindleberger used to say nothing causes more angst than watching your neighbor get rich, right? So there's enormous pressure to participate, and people jump in and they think, I'll just get out in time. I'll get out before it blows up. And that's the very dangerous part of this. The market won't give an opportunity for people to get out. It's going to go down really quickly. So as difficult as it is, I think people should cut risk. And folks like myself, I don't have a lot of credibility right now. Let's face it, right? Analysts of bubbles, bubbles is like an evil word. But the reality is bubbles have been around for hundreds of years. They inflate and they always burst, and this one's going to burst. We don't know when. And I think it's just time to hunker down and be very cautious, very cautious.
All right. Well, let's get a little prescriptive here. And Doug, we've taken up a ton of your time. So if you need to leave, we totally understand. But if you're able to stick around for a few more minutes, I'd love just to kind of popcorn with you and the New Harbor guys on just a couple of ideas that a concerned investor who's been watching this video, should potentially consider as options for how to potentially position themselves defensively. As you said, hunker down. Don't be putting all of your assets fully long the big market run that's going on right now. So Mike, I haven't called on you yet, and I'm sorry for that. There's just so much great material going on here right now. But let's talk for a moment about the precious metals. That's something that you guys at New Harbor and we at Peak Prosperity have been touting, really for the past decade as one of the asset classes to consider putting money in. One, because we think it's, at least historically, has been undervalued given what the central banks have been doing. And two, we believe that it's, offers good inflation protection. Even in the deflation, while the price may go down, it will not likely go down as much as the overinflated paper assets that are out there. At Peak Prosperity, we have our own bias about kind of moving from paper forms of wealth into more tangible forms of wealth anyways, because we think that that's where the sustainable storage of wealth is. But if you can just riff off of what Doug was saying, maybe give folks the literally 20 seconds on why you guys do hold a fair amount of precious metals exposure in your portfolio, even though the rest of your portfolio is largely in cash and out of the market for the reasons that Doug was mentioning. And then if you want to say anything about, well, let's start there and then I'll ask you a follow-up question.
Okay. Yeah, and don't worry about not calling on me, Adam. I don't mind taking the night off. There's not a heck of a lot to add after, what these other two guys said. This has been a remarkable bubble. It has been tiring, to warn about for years on end. And of course, central banks have stopped at nothing to push it a little bit higher. I've got some things written down, some technical indicators that are off the charts, but we've talked about them all, and it's almost redundant at this point. The bubble's massive. Nobody knows when it's going to end. When Doug says it can go to a much unimaginable heights and then double from there, the thing that's funny is that even at that double, there'll be people saying, "Well, geez, it could just keep going higher." So, why question it? It's true. I mean, everything we see is completely off the charts. It's the bubble of all bubbles, and to that point, we're just not really playing in terms of the equity market. I would tell people to take Doug's advice. Our advice has been for quite a while now to reduce stock market exposure significantly. Our portfolios are essentially net zero exposed to the stock market. We're neither long nor short. We're pretty flat. We'd suggest that people get down to at least below a third exposed. Most people seem to be in a traditional, most new people we talk to in general, or the public, seems to be in a perpetually balanced 60-40 mix of stocks and bonds. And we think it's going to be hard to react to the type of market pullback that's likely to eventually come if you're already that exposed. But if you're below 1/3 equity, or even better, down towards zero, you're going to be able to react a lot better and furthermore, ride out whatever comes next here. But gold and silver, to answer your question, gold and silver is the easiest tangible asset to own, to trade, to store. It is the asset that's completely outside of central banking control. Some people talk about Bitcoin too. That's also in that category, but gold and silver is one that we much prefer. It's been money since the Roman Empire and even before that. So in our portfolio, we have, like I said, mostly cash and T-bills at present, close to 70%, but we have a component of between 10 and 20% gold mining stocks. We've got some pretty tight hedges around those stocks at this point. We're actually in one or two exchange traded funds that tracks the whole sector. We think it's more important to be in the whole sector than in individual mining shares. They've had a fantastic run. Because of that, we're up in our portfolio close to, well, depending upon the account, 8, 9, 10%, something like that this year. Even with that being our only equity exposure, because this whole sector is more than, it's doubled or a little bit more than that. We still think there's some room to run in the mining sector, but we're tightening hedges by buying puts below the market and paying for them by selling calls on part of the position to bring in some cash. But we by no means think the run in miners is over. It's due for a pullback. We want to keep the tight hedges. We would even add for new people right here, right now, with some tight hedges. So that's the mining piece. The miners, we think, are going to do very well. It's a leveraged exposure to the price of gold and silver. As far as gold and silver itself goes, we like bullion. We think everyone should own some, one way or another. Best way to own it is the bullion form. Get it delivered to your home. We've been telling our clients that for years. And that's really outside of our management. We want people to get physical gold and silver in their hands. And for the last few months, silver has been at such an extreme discount relative to gold, because it went to something like 123 to 1 in terms of the ratio of gold price to silver price to gold price, or the other way around, actually, that it strongly favored silver. That's actually reduced recently to maybe 70. I didn't calculate it today, but it's around there. So silver is still slightly undervalued relative to gold, but not as much. So if one were to buy today, it's a little tough because silver has been going absolutely vertical and again today. But I think we'd still say, if you want to establish a position, maybe buy a fifth of it here right now, just to get something started. It's not going to make that much of a difference, to buy something. And we're more ambivalent to gold versus silver at this point. So bullion, people should own some, get some if you don't have some already. And mining stocks, we think, are still at the early stages of what will probably be a multi-year bull market.
All right, thanks, Mike. So, Doug, you have you obviously have a defensive outlook given everything that you just told us, and you manage the Prudent Bear Fund, which is tries to prepare people for bear markets. Do you have any reaction one way or the other to what Mike just said about precious metals? In other words, do you think that they play a good role today for people that are looking for defensive investments against what could happen? And are there any other investment categories, real estate, farmland, whatever it might be, that you think would also be worth considering putting in a portfolio that was trying to position for the kind of downturn that you think might be coming?
Sure. I've been at McIlvaney Wealth Management now for 4 years, and I run a specific strategy, the tactical short strategy, which is a hedging product. But I'm also on the team at McIlvaney Wealth where we call it the MAP strategy, which is hard assets. At McIlvaney Wealth, we love hard assets. So we agree completely with your view, Mike and John. We bullion, the miners, we own silver, platinum, gold, the miners. We also have a component for real estate, global infrastructure, et cetera, because we just look at this as ongoing, probably an acceleration of global synchronized currency devaluation. We're seeing it with the dollar, but so, these markets could be volatile, but we believe over the long term, you want to be in hard assets. So I agree completely with what Mike was saying.
All right, great. And one other question for you before we let you go, Doug. I think Mike was alluding to this a little bit earlier, but you have people in market run-ups right now who feel like, it might be getting a little bit heady, but when it looks like things are really getting near the end of the bubble, I'll get out. I'll be one of the first guys out the door. I'm just going to go over here close to the door, and I'm going to dance close to the door and be one of the first people out. And of course, if the majority of people are thinking they're going to be one of the first out the door, mathematically that doesn't work, right? You survey people, and 80% of people think they're above average driver, right? And just mathematically, that's just not possible.
Recall back during that period in February and March where, this is a global bubble, and we saw events in Asia or Europe, and then we would come into the US market and we would be limit down at the open, right? Huge down at the open. So people the previous afternoon might think, okay, I'm going to come in tomorrow and cut back a little bit. Well, we could have these huge gaps down and very little liquidity, and everyone's going to want to sell at the same time. And the whole world thinks that they can buy options and derivatives to hedge themselves, and the market can't hedge itself, right? Someone has to be able to take the other side of the trade. So structurally, this is set up to catch people, and then the market starts to go down, and they'll say, "Oh, I'll cut back in the next rally. I'll cut back when the Fed, intervenes in the market's rally." The next serious downturn that may not come, and that's when people will start to panic.
That's a great point on so many dimensions. I'm really glad you mentioned the overnight markets, because that's really what's been driving a lot of the action over the past couple of years. We've seen some of those charts. I'll put one up here if I can find it, but it shows that the vast majority of the market's gains have happened in the overnight market, and so you have these gap ups in the morning, or in the case of what happened in early March of this year, huge gap downs in the morning, right? So even if you've got a plan when you go to bed, you don't have time to execute it in the morning because the market opens far differently than it did close the night before. All right, well, Doug, look, thank you so much for joining us today. I know you're a very busy guy, and to give us so much of your time is a total treat. So thank you. I hope we can have you back on the program again at some time if that works in your schedule and if it's of interest to you. But it's been such a wonderful discussion. So we'll let you get back to your clients and your trades, but thank you so much for joining us.
Hey, it was a treat for being on with you, gentlemen, today. Thank you, Adam, John, Mike, and I'll look forward to doing it again. All right.
Great.
Good chat with you, Doug.
Take care. Bye-bye.
Thanks, Doug. All right. Well, Mike and John, just in closing here, want to wrap up from picking up sort of where we left last week at what we think the markets might do in the near term ahead. Looking at the activity over the past several days, it really just seems to be continued melt up. There doesn't seem to be weakness in any areas. So two questions for you. Do you guys foresee much changing in between now and when we meet next week? Is there anything that's caught your eye that you think might have significance for something new happening in that short period of time? And then secondly, for people that have been watching assets they hold melt up, whether they're tech stocks, right, or whether it's even gold and silver, as we just talked about. Silver's basically more than doubled in the past couple of months. What advice would you have for those people who are looking to maybe lock in those gains, or at least put in a hedge so that if there is some sort of market correction, they are minimizing the impact that it would have on those positions?
On the bullion piece, Adam, I think that our advice to people for a long time has been to build a core position in bullion. That's different for everybody. I don't really think that it makes much sense to trade out of that or even hedge it just because silver's gone to 27 or 28 from 15 or 16, or the gold's at almost 21 from a low of 12. We do have some clients and some people that ask us that aren't yet clients that are significantly overexposed to gold and silver. And if that's so, it's a great time to hedge, or just simply sell some, which is the purest hedge of all. It's just to sell some of the asset, But we're telling people in general to have about 5 to 20% of their portfolio or their net worth in bullion. And, there's nothing set in stone. And I don't really think that we have to worry about selling yet. I mean, I don't think we have to worry about selling that if it doubles from here. The portion that we're telling people to hold as a core position is a very long-term hedge against the ultimate idea of runaway inflation. That's the way we look at it. However, we do have strategies and tools and responses to help people that want to hedge, whether it's, using options to hedge by selling call options and using the money to buy puts, or we, can tell them how to use futures markets, though we don't do anything with futures markets directly for clients. But, if somebody has an overexposed amount, I might just suggest they literally sell some. That's my opinion.
Yeah, I'd add just to that, Adam, that so much in investing is a psychological endeavor, and this is where even the act of thinking about trimming or selling a little bit of a concentrated position becomes really hard psychologically, because especially when things like precious metals are on their very vertical like ascent here. But I like to remind folks that this is not an exercise in perfection or even precision. And to really get comfortable with the idea of having some regret. Every investment decision is going to have some tone of regret. I can guarantee it. So I think a lot of the psychological work happens to be with getting comfortable with not being perfect, because it's not possible, and to be okay with some level of regret, feeling like, oh, there was some I could have been in and missed that little bit out, but it's okay. I've got the big picture right. The other comment I'll just make quickly about, you asked about the markets in general. So I mean, the S&P 500 had been kind of trading in a kind of a sideways channel for the last, since early June, I guess. And this week, we took out, say, 3250 on the S&P. So you might say that was a pretty significant point of resistance that we've broken through. But look, we're about 1.3%, I think, off of the all-time high. So which would, of course, be the next logical, resistance point. So I don't put a lot of significance into this upside breakout, because it's really, staring down this all-time high from February 19th with very little headway to go. So no, I don't think there's a tactical or technical reason to be dramatically changing one's position in a more bullish way in any way whatsoever.
All right, thanks, John. And just technically, when the market did break back in late February from those all-time highs, it did so by opening a gap. It gapped down, and then there was all the market carnage that Doug was just talking about. We have been talking over the past couple of months in these videos from a technical analysis side that there have been a lot of gap ups since the bottom. And at some point, the technical analysis, one of sort of its rules is that gaps need to be filled. And in all the gaps that opened on the way down, all of them have been filled except for the one right there beneath the all-time high. And I believe we just filled that gap. And so there are some technical analysts out there who hadn't been willing to predict a market rollover until that last gap was filled. And of course, on the market recovery, there were a lot of gap ups in that recovery, and now there's a whole bunch of gaps below where we are right now. And so from a technical analyst standpoint, the week was important in the sense of closing that last gap that remained on the upside and now leaving nothing but gaps on the downside. So if you're into technical analysis, that is one thing that can maybe give you a little bit of a sense of, hey, maybe there's a greater probability than there has been in the past that markets might actually start rolling over here. All right, I really appreciated too that you talked about the psychology and just even sort of exercising those muscles of being open to reallocate, being open to take some chips off the table, and realizing that there is no perfect decision. You're always going to feel a little bit like you either sold too soon or sold too late. One thing I just want to underscore, because I agree with all of that, is that this, as we've said before, the research is really clear. Psychologically, we as mammals, we feel the pain of a loss twice as more than we feel the joy of a gain. And I think nowhere is that probably more clearly felt than investing. And what I mean by that is much better to leave some on the table, but make sure that you've sold and secured, your gains or the value of your wealth, than it is to try to reach for a little bit of extra gain and end up losing a big chunk because of that additional risk. So just a little bit of research to back that up. All right, in closing, guys, because we're at the end of our time here. If you've been watching this, especially if you took everything that Doug talked to heart, if you are interested in working with somebody if you're interested in looking at your financial situation and assessing whether you might be too exposed to the type of downturn that we've been talking about, we highly, highly recommend that you work in partnership with a financial analyst who understands the risks that we talked about here today in terms of evaluating your situation and coming up with a plan. If you've already got a great financial advisor, hey, if you're working with a great guy like Doug Noland, excellent. Stick with him. As I say every week, they are literally worth their weight in gold, and gold is getting more pricey as we've just been talking about on this segment, but they're worth their weight in it. But if you don't have one yet, then I strongly urge you to consider reaching out to the guys at New Harbor, to Mike and John and their team there. And they offer, in partnership with Peak Prosperity, a free consultation for anybody that reaches out to them to talk about their, they'll review your portfolio. They'll tell you where they think you're vulnerable. They'll give you their best advice. It's completely free. There's no obligation to work with them. If that's something that's of interest to you, just stick around for the end of this video, because we give you all the details on how to do that. Mike and John will also put up the greylockpeak.com URL whenever you're talking here on the video, so it's really crystal clear for people who want to reach out to you how they can do that. And with that being said, guys, thanks for another great week. Doug was a great guest. I've already got a an extra special expert guest lined up for next week. I'm going to be a little cryptic on that because you never know how people's schedules may change, but we're now really beginning to get some really impressive people who are hearing about this market video series and wanting to come on it. And so if you're watching here, folks, if you're enjoying this series, it's only going to get better from here. So with that said, Mike, John, guys, enjoy your late summer time back in New England. It's nice. It looks like you guys are both back in the office. I don't see you at your home offices this time around. So hopefully that's a good sign that things are maybe loosening up a little bit coronavirus wise in your part of the world.
So far, yeah, we're in the East Coast of Massachusetts, and certainly there's plenty of cases around, but the data has been okay, and we've been out of the office for a while. I want to get back in here. Don't know if we'll be in here all the time or how long it will last, but so far so good.
Still trying to figure out if there was some gentle nudging from our wives to get out of the house for a day, but we won't go there on this video.
All right, guys, look, well, enjoy the time between now and next Thursday, and we'll see you in a week to do this over again.
All right, thanks, Adam. Good to see you.
See you later.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.